Great. Well,
Like,
this is recorded, so I'm sure people will continue to join um, and um, and for those on the call, I think the plan is I'm going to do just a very kind of short intro and framing, hand it over to Rocky. He's going to give kind of a short framing of how fundamental investors use quant toolkits. And then we're going to do a little bit of just fireside, some questions that I have for Rocky. And the goal really here um, is to give you the opportunity to ask some questions as well too. I mean, we're obviously building a course around factors for fundamental investors, but part of our mission too is to provide some of these learnings and frameworks just broadly in open source for free as well too. So thank you so much, Rocky, for being here. I'll tell my quick story about empirical research. I had never heard about empirical in 2008 until Mike Goldstein came into our office at my first hedge fund. My CIO brought him in and invited the analysts to join. And the first time I met Mike, I'm like, wow, this guy seems really smart. I'm not sure I understand most of what he's saying, but I want to pay attention to this stuff and this work. And that was almost 17 years ago. Geez, I'm getting old. And I've been an avid fan of empirical research since then. It's to me a rare resource, a highly usable, highly effective research product that I found really instrumental to my process as an analyst and portfolio manager over 13 years. And really what they do is provide a really structured view towards quantitative analysis with the factor lens and various models. I met Rocky first, I think in probably 2013. Rocky's a US strategist and Empirical Research Partners. And as we at Fundamental Edge started to build out more curriculum around factors, my first call was to John and Rocky because they just have the expertise, some of the world's strongest expertise in this area. So thank you so much for being here, Rocky. Um,
great to be here.
Maybe do you want to just elucidate anything I missed about your background and what empirical does? And then maybe we could start with, I don't know if we want to pull up a few slides of just the framing of some of the curriculum you've built or get into the 101.
Yeah, absolutely. Happy to do that. I'll just start with my background very briefly. So I've always been a quant and I've worked on the sell side so my entire career. So that's basically advising everyone from hedge funds like places that Brett has worked in the past through to big long only mutual funds. I started my career in 2003. Gosh, I'm getting old too, in Citigroup down in New Zealand of all places. So if I sound weird, it's because I've got a little bit of a Kiwi twang mixed in with my Kansas accent. So I've been sell side my whole career and really over that time have started to build up, I guess, hopefully some expertise in helping particularly fundamental investors use quantitative tools. And that's certainly our focus at Empirical as well. So, there's plenty of very sophisticated quantitative hedge funds around that run more of a black box process. That's not our area of focus. We're much more focused on trying to build a toolkit that's transparent and practical and pragmatic that fundamental investors can leverage, really just to help them shift the odds a bit more in their favor. And so that's what I do here at Empirical, where I've been for, this is my 13th year, I guess, at Empirical. And the program that we put together is really trying to build, again, a very pragmatic toolbox that can hopefully help you in your careers. Just shift things a little bit in your favor. Any edge you can get in the market is valuable. If you can find a model that shifts things 5, 6, 10 points in your favor, that is tremendously valuable if you apply it over time. And we're going to try to talk about some of those things that can give you a little bit of an edge in the market. So I'll pull up my screen here and maybe just give you a little bit of a sneak preview of what we're going to talk about in the course. I think, Brett, you
Yep,
maybe
your
need to
co-host now, Rocky.
There we go. Thank you. Okay, so what I'm going to be focusing on is, as I mentioned, kind of a toolbox from the ground up. So we're going to start with really the very, very basics of what a factor is. And We're going to stick with, I think, a non-academic definition of a factor. We're going to talk about factors as really just a tool or a way of ranking stocks, hopefully with good stocks at the top and bad stocks at the bottom. There's a lot of, nuance in the academic world about how we should define an alpha factor versus a risk factor and things like that. We're going to try to focus on ultimately what we all care about, which is just trying to outperform the market. So we're not going to get too hung up on all the technical definitions of what we should call a factor and what we shouldn't. We're going to talk a lot about also when to use factors, right? So we're big believers that if you find a good factor, it's not going to work all the time. Nothing does. So a lot of what we're focused on here at Empirical is when should we use certain factors, or given the broader macroeconomic or market landscape, what's the right toolbox to bring to work every day? And factors are kind of our tools, and we want to know which ones we should pull out of the toolbox. So we're going to talk about ways to time factors as well. What we're going to do is, as I mentioned, start with kind of the very basics, and we'll talk about in that some real world factors. Ultimately, one of the things I hope you take away from this is some ideas on where you should start, which factors work and which ones don't. And so we'll talk about that just to kick things off. Then we're going to talk about the why of things. And this is something we're really focused on here at Empirical. And this is particularly true now, I think, in an AI-dominated world where you have almost infinite computing power. You can find any number of things that predict stock returns, right? Random data variation means you're going to find one thing that happens to be correlated with future returns. Whether that will keep working or not largely depends on whether there's some kind of reason behind it. And so we spend a lot of time trying to understand what's the behavioral or economic reason behind factors. Why do they work? And I think we are big believers that if you know why something works, you've got a fighting chance of hopefully finding the things that are going to work out of sample, right? The big problem with factor investing is you can, again, overfit in sample. You can find lots of things that look like they predicted stock returns, and then they fall over as soon as you start using them because you got the why wrong, or there was no why. So we want to understand what is likely to work in the state of the world that we face now going forward. We'll talk about other types of factors that are tied to events as well. So we'll talk about factors related to things like activists. That's fairly topical these days. Things like changing your CEO. There's certain events, M&A being a big one as well, which will probably pick back up this year, that have some kind of payoff profile, and it's useful to know what that is. I already mentioned factor timing. We're going to talk about when we should use what. That's a big part of where we think the alpha in factors lies these days, particularly because anyone with a computer can compute lots of factors now. That's not that novel. Knowing when to use them, I think, is still something that's a little bit trickier. And then the final thing we're going to talk about is we're going to put everything together in a real world example. And this example is something that's used extensively by our clients. Certainly Brett has used it in his former lives. And that is a model that we call our failure model. So this is a real life model that's been in live use by our clients for 20 plus years now. It's got a real-time track record. And only use that as an example of kind of putting everything together. Everything we learn together, we'll try to put into that model, and you'll see how real-world portfolio managers and analysts are using a model every day in their day-to-day job. So that's basically what we plan on tackling. And maybe I'll just pause there and see if there's any questions, Brett, that you wanted to dive into.
Yeah, one that comes to mind, Rocky, is, obviously many institutional investors will use a model like this, or many use this specific model. For those that don't, either due to resources or other reasons, are there a few just heuristics that you think are helpful, that are learnings from the models that could be applied without a data, weekly or monthly data run? I'm thinking like things like the difference between cash flowing, cash burning. Like, what are the
Yeah.
3 or 4 top heuristics that come to mind?
Yeah. There are a few, and I think that if you don't learn anything else, just kind of having at your fingertips a few of these is useful. So the first thing that I'm going to say is pretty consistently, equity investors overpay for growth rates and they underpay for profitability and particularly free cash flow profitability. So what I mean by that is, and we'll talk about this in the course in more detail, but if you just look for fast growing companies, so let's say I just sort all my companies about how fast their top line is growing, what you will find on average is the fastest growing companies underperform thereafter. And it's not because they're bad companies, it's just that the market tends to over extrapolate how long they're going to be able to keep up that supernormal growth, right? The way they got to the top of the rankings in the first place is because they've done very well up to that point. But what you find is that growth rate tends to fade thereafter quicker than what investors tend to think. Conversely, companies with big free cash flow production, so let's say we measure that just by their free cash flow margin over the last 4 quarters, that tends to be more durable than what equity investors tend to price. Meaning, if a company has a high margin today, the market often assumes that that margin is going to mean revert, which is kind of what like economics might say, right? Like you shouldn't be able to have this massive margin. Competitors will come in, your costs will go up, it'll get competed away, etc. The market tends to overestimate how quickly that profitability is going to roll over. So they overestimate how long growth rates can keep going, and they underestimate how long margins can hang in there. And so what that means is a very simple heuristic is in a portfolio, you want to lean a little bit more towards companies with proven free cash flow production, and you want to lean a little bit away from the fastest growing companies. Doesn't mean every time you want to do that, but just on average, that is something that's going to shift things a bit in your favor. Kind of related to that, one other heuristic is really fast capital spending growth is on average a bad sign for future returns. Now, this is topical if you think about what the big tech companies, the hyperscalers are doing right now, because what ends up happening is if you have really fast year-over-year capex growth, it's usually at the point where everybody believes the story, including the companies. Everybody's drunk the Kool-Aid. Maybe AI is at that point now, right? People are extrapolating demand up and to the right. People are spending hand over fist to try to capture that future growth and opportunity. And they should probably be doing some of that. But if you're a real outlier on capex growth, it usually is a bad entry point for an equity investor because it means everybody already believes. They believe everything is going to go right. The companies are spending all this money, pressuring their free cash flow margins, and those companies on average tend to underperform. So there's some kind of counterintuitive rubrics here. Like everyone thinks, if I'm going to buy a stock, I kind of want the one with the potential, the growth rate. But you can have too much of a good thing because the market tends to overpay for that. So those are some just very simple rules of thumb that, again, we'll talk about in more detail, but keep those at the back of your mind because we see it all the time with fundamental investors, the tendency to over extrapolate the story.
Can you talk about this concept of, you mentioned it too, just table odds and batting average? I remember a report that was impactful to my investment strategy maybe 10 years ago about serial acquirers. And I think we actually had a debate on this where I'm like, no, you should own Danaher and Thermo Fisher, these serial acquirers, because look, they've been great stocks over time. And I think the quantitative research rebuttal is, well, you're cherry picking one or two instances. If you look at a broader subset of serial acquirers, the failure rate is actually quite high in that business strategy. So how do you think about, can you just kind of level set that mindset for us?
That's a great question because I think particularly for a fundamental stock picker, you really care about just the win rate of whatever you're dealing with, whatever factor you're talking about, right? So in your example, serial acquirers, I think as humans, we tend to remember the success stories. It's kind of very similar to what you see with like VC investing, right? You only hear about the ones that worked, not the 99 that failed. And it's very similar with a lot of the factors that we'll talk about and are used in the market. So in that case, serial acquirers, Danaher has been was at the time a tremendous company and outperformed massively, and it was doing that with a series of kind of roll-up acquisitions. It was one of the most acquisitive companies in the market at that point, and it worked out for that company. But you have to be very careful about extrapolating that because the study that Brett's alluding to, we looked at all the other serial acquirers, and actually what you find is just statistically the ability to do that. That was a very rare case. What usually happens is as you do each successive acquisition, your odds of that working out go down. And so where quant is valuable as a fundamental investor is just giving you like a table of those table odds, so just historically of all the companies that have had this set of characteristics, in this case, lots of acquisitions, what's the probability that they actually kept working and outperforming over the next 1, 2, 3 years, whatever? And that number is what you really care about if you're a fundamental stock picker, right? So, if you can find a fact or a model that, say, gives you a 60-40 edge, meaning like 60% of the stocks that have that attribute have gone on to outperform and the other have underperformed. That's actually a pretty good edge. It doesn't sound like much, and it's not much for like a single coin flip, like for one stock. But if you can consistently apply that edge over all the stocks you deal with over the course of your career, it's almost certainly going to add up in your favor, right? Like if you're flipping a 60-40 coin lots of times, one flip, pretty close to 50-50, pretty quickly adds up in your favor if you do it consistently. So, you might have got lucky on Danaher, but if you keep trying that, it's probably going to add up against you, because that was a factor that just doesn't have a high hit rate. In fact, it has a high failure rate, actually. And there's many factors out there like that, like even the one I talked about before, just high top line growth. Again, you only hear about the success stories, right? You hear about the NVIDIAs of the world. You don't hear about all the other ones that didn't keep their growth rate up. And so you really want to know every time you see a factor is what's the win rate? Like what is just the batting average over the next 3 months, 6 months, year? That's really an important thing we'll look at when we're putting it together. And the whole point of factors is as you start to combine factors, you can usually boost that win rate, right? So like a single factor might, if you're lucky, have like a 47% hit rate, right? 53% of the stocks with that attribute go up over the next year. But if you put two factors together that are both good factors, you kind of triangulate a smaller set of stocks, they might have a 55 win rate, and then you can maybe add a few more factors and get it up to 56, 57. Then maybe you can put a bit of factor timing in there and get it up to like 60, and then you're in business. If you can find like a 60-40 edge in the market and apply that consistently, that is really going to help you over time.
Yeah, that makes sense. Yeah, I use that one as a good example when I tell people about empirical, because the serial acquire, that's like a very evidence-based approach. I'm like, all right, maybe I should shift to like thinking about shorting more broken roll-ups when they stub their toe, because when roll-ups unwind, they tend to have this long period of unraveling. That's great. Can we talk about, one of the kind of the OG factors, the value factor? I think there's been debate in recent years about what is value. Historically, in Fama French, price to book was the value signal, but today's modern businesses don't have, are more intangibles heavy on the balance sheet. How do you think, and how does Empirical think about the strongest, most persistent value signal in the market?
Yeah, so it's a great point about the shift to intangibles. I do think that has rendered price to book a fairly ineffectual signal, and we'll show some evidence of that in the course. It's just not been a very good factor, largely for the reason you said, like the tangible assets of a firm just aren't really usually what you're paying for or what's creating the value anymore. It's a lot of intellectual capital. It's, network effects, scalability, things like this. So when we define value here at Empirical, we've had to evolve our definition over the 20 odd years that we've been in business, and moved from a valuation definition that was more rooted in the physical world into one that's more suitable, we think, for an intellectual capital world. And there's a couple of ways we've done that. Probably the biggest way we've done that is we've said, forget about the assets. What we really care about is how much am I paying per dollar of free cash flow that this firm can generate. So we're valuing the company on its ability to produce ongoing free cash flow. And so then it doesn't matter whether that free cash flow is coming from physical assets or intellectual capital assets. We're kind of saying, well, at the end of the day, that's what I care about as a shareholder, is how much free cash flow do I get in my pocket. And so how much I'm paying for that stream of free cash flows is kind of what matters. And so that's been very helpful to us. It's pivoted us away from physical assets. It's also kind of pointed us towards sort of asset light businesses, right? Because often the big free cash flows are found in businesses that don't have to spend a lot of capex. And of course, you see that in some of the mega cap tech companies now. And so that has become an increasingly important part of our definition of value. We do look at other intellectual capital measures as well. So we look at how much you're paying for the accumulated R&D in the firm. That's kind of a new age value factor. You're capitalizing the past R&D spending and saying, well, that's sort of like some crude sense of how much intellectual capital you have, what's the market willing to pay per dollar of that accumulated intellectual capital. That's been a pretty good value factor as well. We include things like patents in there as well. So we've had to make that transition just like everyone else. And it's quite important because, if you look at, say, the mega cap tech companies right now, on that basis, because they're so free cash flow productive, they don't actually look egregiously expensive in our framework, nothing like what you had, say, back in 99, for example. So the definition of value really matters. Even with that better definition of value, though, I would just say as an aside, we still think you have to time it. The old idea that, like, you've got this Fama-French value factor where if you just keep a constant exposure to price to book, you're going to like steadily accrue this, little bit of alpha every day or every month, and that's going to like be enough. That's long gone. The alpha to value, even a sophisticated definition like we think ours is still very episodic, and you want to know when to use it. And we'll talk about some of the things that we use to time it. So I think the combination of a better definition of value plus timing it, those two things together give you a chance of producing some alpha out of value still.
Interesting. Can we unpack that a little bit, both from a sense of, using your models, what are the strongest signals to time value, but again, are there any heuristics for those, on the call who are just looking for broader signals to time value that they may not need a model to deploy?
Yeah, I mean, I think the simplest one, but also the most effective, and we use this, this is the single biggest factor that we use in timing factors, is the idea of the valuation spread. And what the valuation spread is, you can think of it at a high level, it's just like the dispersion in valuations across all the stocks in the market. So it doesn't really matter what your valuation definition is. Let's just, for a moment, say price to book, right? Sometimes all the stocks will be trading on similar price to books. Other times they'll be trading on very different price to books. So in a sense, it's a range in valuations across all the stocks. Now, sometimes, usually when things are going well and everybody's pretty comfortable, there won't be much spread across the market in terms of valuations, because the market's like, oh, everything's fine. We can just give all the stocks kind of the same valuation. At other times, usually when things are going terribly wrong, like, say, mid-March of 2020, early in the pandemic, or, September of 2008 when Lehman Brothers is going under, things like that, you're going to get a really wide valuation spread. And the reason there'll be a really wide valuation spread is some part of the market will be trading on going out of business type valuations, right? So in the pandemic, almost 5 years ago now, it would be, restaurants, airlines, cruise lines, hotels, retailers, all these real world businesses were trading at, is this even a going concern type valuations? And then you had safer, more defensive stay-at-home businesses at richer valuations. So you got this enormous spread between the cheapest and more expensive stocks in the market. That's when you want to bet on value, because you can think of the value spread in the equity market as like basically just the equity market equivalent of a credit spread. And the credit spread, as many of you probably know, is, is kind of saying, what am I being paid to take on risk? Same in the equity market, right? The valuation spread is telling me how much am I being paid to be contrarian. And what we've always found is equity investors, being human, tend to over extrapolate whatever the problem is, right? So when you're, in that early part of the pandemic, it's like sell first, ask questions later, panic. Nobody's seen this before. Just get me the hell out of here. And so you get this enormous spread, but actually as an investor, you're being compensated for taking the other side of that. So that's when we want to buy the cheap stuff. We're being paid to take the other side of the market's fear. And so if you just watch the valuation spread, that'll give you a pretty good a starting point for thinking about when you want to allocate to value. Now, just to be clear, that's not to say it's easy, right? Because this is going to tell you to go long value. And in our framework, basically, the valuation spread peaked on March, I think it was 18th of 2020. I mean, I think the S&P was down almost 10% that day. So it's telling you now you got to close your eyes and dive in the deep end. So we're not saying it's easy, but that's why you need a tool to tell you when to do it, because we'd be way too chicken to just do it on our own accord. But if our model tells you have to do it, at least you kind of close your eyes and click the button, right? So you want a really wide valuation spread when you want to make a value bet. Now, when the value spread is narrow, you're not being paid to buy a riskier stock. In fact, you're probably not being compensated enough. The market is too complacent. And that's more the state of play right now. The valuation spreads are quite narrow. When you get into that world, it's going to be more momentum, it's going to be growth, it's going to be quality. Because if I can buy sort of a better business for the same valuation as a riskier business, I should probably do that, right?
Right.
And so that is a very simple heuristic for thinking about timing the value factors. When the spread's wide, go long value. When the spread's narrow, go long momentum and growth and quality. And that's built into our models. Not quite as simple as that, but that's the basic idea.
Right, right. Super helpful. Looks like we have a question in the chat from Michael and then a hand from Sean. So let's go to take some questions from the audience. Michael is interested in understanding the quant research on CEO change management. Is there alpha short term or more longer term, or what other signals? This is me editorializing. What other signals would you overlay to understand CEO change?
Yeah, so a CEO change, we have found that it is most effective when you use it conditional with value. What I mean by that is basically if the stock is really cheap, usually because what they have been doing hasn't been working, think maybe Starbucks recently, right? And then you change the CEO, that generally actually works out. Not necessarily because the new CEO is, in some absolute sense better than the old one, but the market just wants to see some change, right? Like if you're a really cheap stock, clearly things have not gone well. And so changing anything gives you some option value. It's better than doing nothing and just continuing on your way down, right? So we tend to find that the intersection of a CEO change in a stock that's trading very cheap on our valuation metrics is a good signal. We actually use it in our models. So just on average, changing CEOs is not that great. It doesn't really matter that much. Sometimes it works, sometimes it doesn't, but you get a lot of potency when the stock is starting off cheap. So it's like a catalyst for maybe re-rating a cheap down and out stock. So you can see what I mean. Boards are not stupid, or activists are not stupid to try this. I mean, you might as well try something if what you've been doing hasn't worked.
Right, right. That makes sense. One of the things I think the first time I heard the concept of time arbitrage was from Empirical, and I think it's even more topical in 25 with the hedge fund complex really shifting towards higher velocity multi-manager hedge funds with trading stepping up. Can you tell us a little bit, Rocky, just about your observations of how duration approaches have shifted in the marketplace over the last 5 to 10 years, and this, how does Empirical and how do you think about this
Yeah,
concept of
yeah.
time?
So it's something we've had to think a lot about. Just as you said, there's a changing cast of characters in the market, and they have different objective functions, basically. And as you rightly pointed out, one of the big shifts has been towards platform type hedge funds that are running, mini pods. And essentially, what they're in the business of doing really is like volatility management or drawdown management, right? They're trying to avoid big losses. Part of the way they do that is diversifying their alpha stream across lots of different teams, but they're also very tightly managing the risk of all of that portfolio of alpha streams, basically. And one of the things they do to do that is they generally cut their losses very quickly. And I'm sure you've heard horror stories about you're down 1 month and you're fired, that kind of thing, because they're running very tight risk controls. And so what it means is there is actually quite acute loss aversion in the market. And so if something goes wrong in a stock, there's a lot of investors that aren't really, kind of longer term fundamental investors, believers in that as an underlying business. They're trading the thing, and as soon as it starts to go down, they will get out. Now that can spiral pretty quickly, right? If everybody else does that too. And so you can get episodically like pretty sharp moves in stocks. And you see it particularly in kind of high expectation growth stocks. You slip up at all, you miss slightly and boom, you're down 30% instantly. So you get that kind of behavior. Now, sometimes when you step back, that is overdone for an investor that maybe has a 1, 2, 3 year horizon, that is thinking about this business as a real world business that is, going to invest some money to generate cash flows down the road. And so we've often tried to play that disconnect. And what we found in our models is looking to the longer horizon is becoming almost like an alpha source in its own right, because there's a lot of people playing this very short-term game, and there's nothing wrong with that. People are many people are very successful at that. But there is an opportunity at this longer horizon, right? Because some of the action in the stock is really going to have nothing to do with its free cash flows 2 years from now, 3 years from now. And so if we can build a model that tells us something about fundamentally, is this a good business, kind of that anchor fundamental value, then when it sells off because everybody's stopping out of the stock and maybe that gets overdone in the near term, that's a buying opportunity for us, right? So it creates an opportunity to maybe be contrarian with that longer term view. Now that there's no free lunch, the downside of that is I have to wear some like short term volatility to get there, right? And I'm buying stocks that are going to be maybe all over the place, way beyond their fundamentals to do that. So that's the trade-off. But if I care about the, I think, returns that many of us care about, which is, I want to grow my capital over some period of time, right? Like real world decisions, like, I want to invest so I can send my kids to college or, buy a house or whatever, then if you can look through and stomach some of that short-term volatility that nobody else wants to stomach, there is some opportunity in those stocks. And so that's one of the things we're trying to play in our models is just extend the time horizon that we're looking at and just try to close our eyes and just like look through some of that short-term volatility, which again is really, really hard. That's why you need a model, I think, to help you do it because it's really hard to do.
Yeah, and as a fundamental investor, it helps to have this support to help you either kind of believe in the alphas of these models or you don't. And now they're not perfect from a timing perspective, but it is helpful. You made a great point that, usually the market offers you the best opportunities when it's not so obvious to everyone else.
Yeah,
It's kind of
it should
axiomatic,
be. Yeah, I
axiomatic.
mean, I think that's exactly right. Like the for me, the biggest value in a quant model is it gives you some comfort in doing the uncomfortable, right? Like at the back of your mind, okay, statistically, like feels awful buying this stock. Like nobody likes this stock. It's blowing up. But the model says, these situations have generally worked out and things are not that bad. And so it gives you a little bit of comfort to do those hard things that just as a human are very hard to do, right? Like we're all hardwired to run away from danger. That's why we're probably still around as a species, right? But that's bad in investing. There are times when you want to run towards danger. That's when you make your alpha, right? It's like what Warren Buffett says, right? You want to be greedy when everybody else is fearful. A recent example like last year would be like Salesforce had a big sell-off because its growth number missed a little bit earlier in the year. Our models love that stock and a big free cash flow margin. Nobody wanted to wear that short-term volatility, loaded up on it. I bought it personally and it worked out. That was like a classic example where the model was right. It was a good long-term free cash flow producer and the short-term was just completely wrong.
Yeah, yeah, yeah. I had a follow-up to the time arbitrage question. The longer horizon factor that's forming, how long does it take for that factor to outperform? So I'll editorialize if one wants to take the other side of this short-term price formation that's accelerating in the market, how long do I have to wait? What does long-term mean in modern equity markets?
Yeah, we found, I think a year counts as our models, we tend to think of as 1 to 3 year type investment horizon. So think back of your mind, a 1 to 3 year holding period, right? So in any of our models, if you look at the list of stocks that screens well or badly today, I'd be very comfortable buying that stock or avoiding it and just not looking at it for another year. In the live performance of our models over the last 20 years now, the alpha decay has actually been out to 3 years, meaning buy and hold over 3 years, you still finish up. You get more of your alpha in the first year than the second and third year, right? So there's kind of diminishing returns, but we're trying to find, we would say, like good businesses in a real world sense, rather than, a ticker and a collection of factor exposures that we're just trying to trade. So that tends to play out slowly, right? A lot of what works over that horizon is looking at how is the management of the firm using the firm's capital, or what's ultimately you, the shareholder, right? That's your capital. You want them to be good stewards of it. You don't want overinvestment. We talked about that earlier. You want them to be giving money back to you through buybacks and dividends whenever they can. They should invest something back in the business, but don't overdo it. Don't, get delusions of grandeur and try to overexpand. Focus on the free cash flows. Those are behaviors that when you see it in companies, might not be the most exciting thing, but over those sort of 1 to 3 year horizons, that generally works out.
Yeah. Yeah, yeah, that makes sense. Question, Brett, could you provide some examples how you as a PM in the multi-manager model leverage this for portfolio construction, exposures overall versus individual security selection? Yeah, happy to, because I really, I had a seminal moment in my career as a PM where I took a large position in Allergan, which was a failure model 10, and I got my chin kicked in. I'm like, all right, I'm going to make some changes to this. And so, what I've done kind of consistently, if I've ingested the loadings from the growth model on the long side, the failure model on the short side, and just kind of constantly monitored my portfolio tilt to these different quantitative models. Now, if you're at a large multi-manager, you will have your classic models, your classic risk factors. You'll have 10, 12, 15, 20 risk factors in your model. To me, those tend to be more associated with risk rather than alpha generation, where alpha generation from the failure model in particular is really strong at predicting underperformance. So if there was a time where I was long the long the failure model and short the growth model, I'd want to have a pretty good reason for that. And so that was always my bias, to have some kind of tilt long the positive models and tilt short the negative models, particularly in the negative models. And maybe Rocky, I'll frame this as a question too. I found the failure model to be particularly potent around event risk, which is something that's very notable for the multi-manager world. Given your constrained beta, constrained factor, event events catalysts are much more important for alpha generation for whatever reason. And we'll ask Rocky why this is. The failure model, short models tend to be more effective on predicting events than the longer models. So certainly, kind of going into earnings season, thinking about the multi-factor models that predict failure, downside risk, is something we would kind of layer over our long book, layer over our short book. So that'd be one kind of structural. Second would just be this kind of regime or episodic point where, I would read the research consistently and kind of understand where we're at in the regime when I wanted to have a value tilt or a growth tilt within my portfolio. It's a little bit of a misconception that multi-managers have to be neutral factors. You basically, like, mathematically can't be neutral factors. There's this game of whack-a-mole. In reality, you tend to have 70, 75% of your book IDEO, but you still have 25 to 30 that's factor risk. And so you have 25 to 30 to play with, to have different factor leans that you can construct in your portfolio. So I think many multi-manager PMs just kind of let that happen accidentally. I think some of the better multi-manager PMs think more intentionally about those factor leans. And so those factor leans were I would try and layer in these models into that factor component. Picking up that question, can you talk a little bit about that concept of event risk? And we mentioned 1 to 3 year alpha decay, but we could talk about how we might use these models for earnings season, for example.
Yeah, so particularly true on the downside. So our failure model, which again is the model we run to basically look for losers or stocks that we think are going to underperform, that gets most of its alpha 4 times a year during earnings season. Because often these are quite high expectation stocks that are showing some kind of cracks in some of their fundamentals, and often the market is starting to kind of question the story anyway. And then you're going into earnings with that kind of precarious situation. That tends to end badly. So particularly for a set of stocks that you might own that are going to be reporting over the next couple of weeks, we have a lot of our clients who will scrub those through the failure model and just check whether they have enough conviction in the stock to hold it through earnings. If they don't, they'll often just take it out because it's not worth it. If they have a strong view that, okay, this thing is going to beat for all these reasons that I've done a lot of work on, that's fine. But again, it's just telling you the table odds, right? Like, in your portfolio, maybe there are 3 stocks that are at a high risk of failing based on the model. That's worth knowing because the earnings, when the new information comes out, that's when you're going to get the big move if the model's right. And so we run a screen for our clients that basically goes out right before earnings season that just lists the stocks with the worst failure characteristics, and that's been worth paying attention to historically.
Yeah. Are there any characteristics that we could eyeball without a model to try and understand where risk might sit heading into earnings, like other
Yeah,
characteristics?
like if you want to triangulate it, it's you could probably triangulate it with kind of 3 things. One, high valuations. That's not bad. It just means expectations are high, right? So if the stock is going into earnings, trading on 100 times forward earnings, the market believes in that thing, right? And so expectations are very high. And so you got to deliver, and there's a long way to fall if you don't. That does not mean you're going to fail. It's not nearly a sufficient condition to say you're going to fail, but it's a starting point. You just got to be aware, okay, expectations are big in this stock. So that's the first thing, really high valuations. The second thing is the company has been spending a lot of money to justify those valuations. So this could be like it's been just binging on capital spending, its inventory has been blowing out really dramatically. And to do all of that, it's maybe raising new capital. So it's been raising new debt or equity. So the picture would be like a high expectation stock that's been, spending a ton of money to keep the story going. And then the third leg would be there's a lot of stock specific volatility in the name, right? So the stock has just been kind of doing its own thing independent of the market. That on its own is not good or bad. But when you see that with those other two pillars, that is often the sign of like some kind of consternation in the stock or just something's going on, right? And in a high expectation stock, you don't really want any turbulence. You just want the thing to be like
Yeah.
everyone believes in the story, it's going smoothly. So the failure model kind of at its core would be like high expectations, you've been spending all this money to meet those expectations, and now maybe there's some cracks appearing in the story. The short-term trading behavior of the name has shifted. That's the ones we would watch out for. Just statistically, that's a bad combo.
Yeah. That's another, just philosophical thing that I've really benefited from, engaging with Empirical over the years is as early in your investment career, you want to run towards controversy. Oh, there's a robust debate here. There's a bull bear. I want to figure out which side and go on that side. And like you realize with this evidence-based mindset that no one wins a knife fight probabilistically. That actually controversy is quantitatively a negative characteristic to
Yeah, you want to be very the ones where you want to go against it are ones where you're very confident that you've got some kind of idiosyncratic view or you've got some kind of edge there, and then you can do that, right? The model is by no means infallible. Even the very best model in our case would be like a 61% hit rate in the case of the failure model, meaning 61% of those stocks do go on to underperform. But there's another 39 that often go on to be superstars, right? So it's playing often in a high octane space. If you have a strong view, that's where you should play because the upside is also big, right? But just knowing that, those sort of odds are 61-39 against you is useful because it tells you how much conviction you need to have to kind of go against that, right? And sometimes people don't have the sufficient conviction and they're probably better off just not going there. Go find something else, right? There's plenty of other stocks out there.
Yeah, yeah, yeah. Yeah, that makes sense. Question, in terms of integrating factor methods into a fundamental investing process, how should we start the process of utilizing developing factors that fit your style, testing them, iterating the process, et cetera?
Well, I think the first thing is, it's got to work with your investment style, right? So the factors you pick if you're a growth manager are going to be different from the ones that you're going to lean on if you're a deep value manager. So what we do here at Empirical is the starting point is, what our name suggests, empirical. We just want to test, back test and see, well, at least historically what has worked. That's a very rough first pass, right? Because there's no guarantee that obviously what worked historically is going to keep working. The world changes, economics change, behaviors change, technology changes. But as a starting point, based on my investment process or the type of stocks I traffic in, there's going to be a set of factors that have probably done better in that space than others. And that's kind of my first pass. And then as we talked about earlier, I want to think about, well, why do those work in the type of stocks that I traffic in? And that'll probably rule out a few more. If I can't really explain why the thing's working, I would be biased towards not using it. I'm going to lean on the ones where I have some view on why it works. So I can see it has worked. Here's why I think it worked. And then you got to think about, is the world going to change, or is the reason it worked going to continue? But then I try to narrow it down to just a handful of factors that have been efficacious in that particular space, and that would be my starting point. And then I would watch it out of sample before I even used it. Just keep a track of it on a paper portfolio, make sure it's actually at least, in line with what you saw in the historical data, then I might start to use it after I've got some comfort that it's actually working.
Yeah, yeah. I think that's one of the misconceptions we're trying to bust in this program too, is factor investing on the quant side is not some like statistical model that Renaissance is running machine learning. It's a lot of the positive alpha factors, the things that fundamental investors are looking for anyways. Measures of quality like free cash flow margin and free cash flow yield and momentum, which is a sign the business likely has momentum. On the short side, it's controversy and downside risk and capital deployment out of whack and poor, other sort of metrics. So I kind of view a factor profile long and short as like a pretty good distillation of what a fundamental investor is doing anyways. And so combining the two is kind of a natural evolution for me. It certainly has been in my career. Rocky, there's been a number of, I think dialing back 10 or 15 years, there's this big promise of quantamental investing that more hedge funds would integrate these two sides. And I just kind of gave the story of why it makes sense, but a number of high profile funds have struggled to integrate the two. Why do you think it's difficult for firms to integrate a fundamental and a quantitative factor investing approach? What are the pitfalls to that?
Yeah, I think one of the biggest pitfalls that I've seen over my career is just like a little bit too siloed, right? You have quants and then you have fundamentals, and the quants are in one room trying to come up with models, and then they take those models and try to, get the fundamentalists to use them, and the fundamentalists like shrug their shoulders and keep doing exactly what they were doing before, because it's kind of two separate personality types, even two teams. I think the reason we have a business here at Empirical is because bridging that world is actually harder than it sounds, or bridging those two worlds is harder than it sounds, right? And I think the struggle quants often have is, they lean too much on the statistics and not enough on kind of the fundamental explanation and reasons for why it has worked. And sometimes you have to trade off a little bit of statistical efficacy for something that's a bit more transparent and understandable. And I think you have to be willing to do that as a quant to get traction, because ultimately there's a human element, right? Like the best factor in the world is useless if you can't get the stock picker to actually use it. And so I'd be biased towards a more transparent model that makes sense, that kind of is a codification of how they already think about the world, over some snazzy AI black box thing that no one knows how it works, but it seems to have produced alpha. You're never going to get anyone to use that, right? So I think that's always been the struggle in the industry, is get the quants and the fundamentalists to work together. I mean, our view would be, as much as possible, it should be one person, right? We are all about fundamentalists equipping themselves with the statistical tools that quants have without becoming, full-on quants.
Yeah, 100%, 100%. I think Rocky has a hard stop. I'll stop with this last one and see if he has any closing comments. What's the best trade you've flagged using factors, and what was a setup? Two come to mind. One was the buy direct call in the spring of 2020. I didn't want to buy direct, and then we got the empirical call, and I'm like, I guess it's time to do it. Another one that comes to mind, back to the value spread argument, was, I forget the exact days, back in the kind of 2017, 18, 19 period. The large pharma distributors, Cardinal, McKesson, were kind of persistently high on the growth score. They were trading at very low multiples given the overhang from the opioid litigations. Fast forward 6 years, McKesson's been a six bagger. So it's a very strong value signal on quality and free cash flow. So I could go on and on. I don't want to brag about all my great trades. I've had very, very many bad trades too. But it just so happens that more of my better trades had some form of empirical embedded in the process. So that's why I'm kind of such an advocate of the firm, and really grateful for the partnership in this educational program. So thanks for your time, Rocky. Any last thoughts before you got to jump?
No, I think the only thing I'd say just to finish off is like, I think the factors often have this like quasi mystical kind of aura around them. They're not,
Yeah.
they're very simple. It's just a way of ranking stocks mostly on the fundamentals that you already look at. They're just a way of defining the table odds of the situation you're dealing with. So that's what we, I guess, hope to do when we talk through these things is just make it simple and pragmatic. There's lots of snazzy formulas out there, but most of those are useless in the real world. Just the very simple stuff is what you need. So with a few building blocks, you can get, I think, a lot of the way there, and then everything else you add is just kind of extra. But the basics, once you understand them, I think it can get you a long way.
Couldn't agree more. Couldn't agree more. Well, thank you so much, Rocky. This was great. Hopefully, we gave some helpful takeaways for people, and for those that are looking for more. Obviously, we have the core program launching in a week and a half too. You can find information on our website at fundamentedge.com. So, thanks so much, Rocky. This was great.
Thanks for having me.
Bye bye.
Bye.
Thanks, John.